So Meet Kevin is back on YouTube. After he left YouTube, he's come back to announce his company, HouseHack, and wants to get your money. This whole video here was a 30-minute long video talking about his company, and it's going to be the greatest thing ever, and using the keywords like AI, artificial intelligence, and their Wedge AI deal finder. It's kind of a lot what you hear from people who are just trying to get your money. They'll use the keywords, and it's just not really fundamentals of a business because the business doesn't exist yet. It does seem like he's doing everything extremely backwards, where instead of building the business, proving it, and getting a proof that the business model works and the business can actually scale and start doing something, he's doing it backwards, where before actually building the business, he wants your money because he wants to take your money to try to build the business. So if it fails, he's not going to be on the hook for that much. We can see right here his table of how much money he's going to invest compared to what investors are going to invest. And I think this tells a bigger story of maybe his confidence in the company, because you see the first one here, like the minimum's 35 million from investors. Kevin will put in 5 million for a total of $40 million. So why would he do that? You gotta ask yourself, if this is such a revolutionary idea and he thinks it's $1 billion idea and a company and there's no way it fails, why would he only want 12.5% of the company when he could build it and scale it himself using his own money and own a way bigger proportion of the company at the time it is to IPO or go public, and where you could sell your shares and make a bunch of money? If you just directly look at this, you can see we'll just take the first one, $40 million in funding. What is the risk that Meet Kevin is taking on that 40 million? Because if he was trying to build the company with his own 40 million, that would be 100% his risk. And if he believes in it, it would be a risk worth taking. But in this 40 million, he's only risking $5 million, which to him, not that much money. He's got a net worth somewhere around like $60 million. He has money to do this. He could do the 40 million by himself, still have money left over, and still be making money from YouTube. But it doesn't seem like he actually believes in this business the way he says he does. Even at the absolute max, or this max here, they have $200 million, which I don't think there's any way he could raise that much money from, his subs on YouTube. But even that, $200 million, he would put in $20 million, which still isn't even 50% of his net worth, for suggested net worth. No one really knows except for him what his net worth is, but he would own less than 10% of the company, which you have the same situation. He's risking 20 million. Well, other people are risking 10x the amount of money he's risking. But it's such a good idea that he's willing to let you risk more than he is, and you get more upside than he does. It just doesn't make sense. That's not how the business ideas work. If you think it's so good, you want to keep as much of it to yourself. You might have heard this term like total addressable market. That's what a lot of people do when their business is maybe they can't focus on what their business is doing because it's not doing much. They'll shift to the total addressable market to say the market we're in is $100 billion market. How could you not want to be in that? That's the vibe I get from Kevin pointing out these other companies.
A company that he is creating is called Flow, and just got a valuation of over $1 billion with a $350 million raise. That's like $2.85 per dollar of assets at the company. That's an expensive raise, okay? Open Door is currently worth about $3 billion. Roofstock raised $240 million at $1.9 billion in their Series E. Vacasa, a vacation rental platform, is worth $2.1 billion. And Landing, a $475 million company, raised $125 million at that valuation.
So that's already problem number one. Just comparing yourself to other companies when you're not those companies. HouseHack has not even started yet. It doesn't own anything. It's trying to raise money before it even has a real business model. It's just a lot of things done backwards. It seems weird. I don't know why he would go about it this way. If it's such a good idea and he believes it's such a good idea, why doesn't he want to own more of the company? If it's $1 billion company, why don't you want to own 100% of that, scale it, show the proof of concept, and then go get investors where when you eventually IPO, if everything goes as planned and is successful, you could own 20, 30% of the company still at that point and make a lot of money. And speaking of the IPOs, the way Kevin talks about how much of a great deal it is to get in now and try and sell you on the idea that there's nothing wrong that could go with this business, he's doing a big disservice and a big problem by assuming everything is going to be successful. He's assuming there will be no hiccups, no problems, and everything's going to go super nice and easy for HouseHack, and only goes up. The valuation, your money will only go up.
Since most companies sell for 2 to 3 times book value right away, this means you're potentially getting into HouseHack at 50 to 67% off of what the market is actually likely to value this company for, which could even be low 2 to 3 times book. We might sell for a lot more than that when we IPO. In other words, you're potentially getting a wedge deal on a company, on a stock in a company.
So problem number 2, he is assuming the success, no problems, and basically guaranteeing that if you buy in now, you could get 50 to 60 or 70% gains on your money, guaranteed when they IPO. Because we all know going from startup to public offering is a super easy road. There's never any problems there. And assuming success in the market we're in right now is a super dangerous thing. And to believe someone who just says there'll be no problems is even more dangerous. If in the market we're in, you cannot just assume everything to be easy sailing and there'll never be a problem. If you go out and raise this $35 million, say 40 million, because that's the total raise. If you raise that 40 million and you deploy it all because they want to buy cash deals right now in real estate, and you deploy it to $40 million in real estate, what happens if the market falls? What if that 40 million drops to 25 million, 30 million? What if you lose tens of millions of dollars on valuation because the market falls? What if on top of that, the market falls, the valuation goes down, and you had all of the houses you bought rented out, and the economy gets really bad, and a portion of your renters stop paying rent? What do you do then? What if you're not getting the cash flow that's coming in, and all of a sudden it flips, and you can't pull the equity out because interest rates are sky high? You're going to pay tons of interest. You can't afford that. Your cash flow just went down because your renters are stopped paying you. And if you want to start getting those rented out again, it's going to take time. You got to go through the legal system. The more time it takes, the more money you lose. You have operating expenses. If you run into a hiccup like that, and you're basically deploying all of your money to buy houses, what if a problem comes up? How do you solve it? This is something I think is being completely overlooked, and it can't be overlooked. Especially in a startup, you have to be able to account for problems. There will be problems. It is not going to be easy sailing. It's not going to go from point A to point B super easily, and you're just going to IPO and have no problems ever. There's going to be a problem coming up. And if you're not preparing for that or planning for it, then it's going to absolutely devastate your company. And if you're investing in this, your money could go to zero easily. Super easily. We all know his course scheme. If you watch Meet Kevin videos over a long period of time, each month he says, lock in your rates now. The course is 50% off, but it's going up in price the next month. It's going to be more expensive. And that's to funnel people into thinking, I have to buy now, because if I don't, it's going to cost more money if I want to buy it later. So it just kind of funnels more people in. And you get that 50% off discount saying like, wow, 50% off, and it's only going to go up in price. You got to buy now. He's doing the same thing in this, where not only is he giving course members the ability to get more warrants, where if you give him money, that's how he's trying to sell his course again, get you to buy his course, because that's free money for him, and his courses are expensive. And if you're in the course, you get 10% extra warrants or something, and if you wait, his warrant system is the first month is at 50%, the second month's at 45%, the third month's at 30%. So you can see how it's the exact same scheme. Lower the percent, make it feel like there's more value today than there will be tomorrow, and try and funnel people's money in.
The warrants will decline every single month. So for example, in September, at the end of September 30th, warrants will go from 55% to 50%. So if you fund before September 30th, you lock in 55%. If you fund before October 31st, you lock in 50%. If you fund before November 30th, you lock in 40%. Incentivized to invest earlier to get more warrants. You're incentivized to be a course member to get more warrants. And you're incentivized to get in early because we might close this round once we've raised enough, which is an internal metric that we have to determine when we've raised enough.
So you can see all of that. His whole pitch there is to try and make you feel like I have to give money now. I might lose this opportunity. And that's the entire idea behind it. Make you think you have to give now. He gets your money up front much faster, and you don't have time to think about it. The declining warrant value, you got to get in now to lock in a higher rate. You got to be a course member to get even more access to more warrants. And he says that they might close the round at a random time that you don't know about because it's an internal metric. Everything said is to try and get you to think, I have to give money now. If I don't, I miss the opportunity. When in reality, what is the opportunity given to you as an investor in this private company in a Series A? What's the opportunity? Your only shot is if this goes public where you can sell your shares for a way more amount. That's assuming success as well. But if you put money into this, if you are an accredited investor, chances are you could do exactly what this company is doing on your own and reap all the benefits for yourself and actually make a lot more money doing it that way. Because in this, you're giving money to a company that goes to meet Kevin, where he gets to decide what to do with it, what houses to buy, to collect rental checks, and you don't get anything. You don't get a dividend. So when rents are paid, you don't get any portion of that. There's no dividend for you. You don't own the houses that he buys because that's the company's owns the houses. You just own stock in the company. You don't have any benefit from this other than saying you're invested in Meet Kevin's HouseHack. So in reality, you could go out, find your own wedge deals, find a good deal on real estate. If you have $200,000 to buy private shares for this, go out and buy a wedge deal or buy some property and rent it out yourself. Then you own the property, you have the equity, you have the ability to leverage that and get tax benefits from that. You can rent it out, and then the rental checks come to you and you get that income, and you don't need to do it through HouseHack. There seems like there's a drastic imbalance here where you're not really getting much for doing this, but Kevin is getting drastic amounts for low risk. If this all succeeds, he can say, I built the billion-dollar company, and he'll have done it with the vast majority of money coming from other people, and he had extremely low risk in it all. And if it fails, he's chilling. At the absolute max, he's putting in $20 million for $220 million total valuation. 10% of the risk is his, 90% of the risk is yours.